Hello traders, and welcome back to the channel. Welcome back to Vertex Investing. And again, I just want to take a moment to appreciate everyone who supported us, followed us on Instagram, Telegram, YouTube, and all our subscribers. And I just want to take a moment just to say thank you for showing us the support. I do apologize for the fact that this video has come out quite late. I've not been well at all myself, so yeah, that's the only reason behind it. So in this video, we're going to talk about liquidity. Actually, before I go on and talk about liquidity, I just want to raise a few things that were brought up in the comment sections from the last video and the video before that, I think. And the main thing is some people were making comments about not giving credit to our mentors and so on, and I don't really understand where that comes from. I mean, it's probably from people who haven't followed us for a while. You would know that we've always given credit to where we've learned from. I mean, my mentor is Rise Precision, and he's actually in our Discord herself, and I'll always credit the fact that I learned smart money concepts from him. I also worked with so many other traders just to perfect what I have at the moment, and essentially what I'm teaching in the Vertex course is because my history is a mechanical trader. I always traded rule based, and what I teach in the Vertex course is a rule-based method to smart money concepts, and it's purely my interpretation. But I've always shown credit. I've never said that I created smart money concepts, and I don't know where this assumption has come from. So I just wanted to clear the air and say, I didn't create it. And to be honest, the market is, considering how old the market is, I don't know how anyone in this generation can say they've created a certain strategy and so on. It doesn't make sense because it's probably been around for a while. So I just wanted to clear that and say I'm not claiming to have created this strategy. I'm not claiming anything really, apart from the fact that I'm teaching my interpretation, and I'm showing you guys basically how you can use it, how you can use this strategy and how to be profitable from it. And it's completely up to you whether you wish to use it. I don't know why you would waste your time in the comments section talking rubbish if you don't really understand the situation. To be honest, it doesn't really make sense. But as always, as I said, the main thing is we've always shown credit, and publicly we've shown the credit. So yeah, I don't really understand. But obviously those who've followed us for a while would know what we do at Vertex. So in this video, we're going to talk about liquidity. So this is number 2 of the Smart Money Concepts Made Easy series. So the only reason I'm doing this is because I want to make it, I realize that everything that I've taught is very scattered in our YouTube channel, and you can find pretty much everything for the strategy here. But I'm going to make this a simpler way where you can just go in order from 1, 2, 3 and so on. So the first video we understood about order blocks, but you need to understand about liquidity as well. So the reason why I've done it in this order is because order blocks is basically your main thing that you need to think about in terms of your entry criteria and so on. And that's basically your POI, your area of interest, point of interest. And order blocks, you can call it whatever you want to call it, like sponsor candles, IPAs, IFCs. I don't know what else I've heard. There's so many other special candles or whatever you want to call it. It's completely up to you, but in theory it's an order block, okay? But we need to know why it's an order block. And remember when I was talking about in the last video, when I was talking about grabbing liquidity. Now you need to understand what liquidity actually is. So the best way to see it, and bear in mind I'm trying to simplify it, try and make it as simple as possible for those who are new to trading, or even those who are experienced can probably take this and take value from it. But essentially, you need to think that the market runs on a fuel, right? And liquidity is that fuel. Okay, for example, every time where you grab liquidity, essentially is the market doing a pit stop. It grabs that fuel and then continues. Okay, so where is this? Where is it sitting? So the most common way to see it is that price. When price is, for example, doing this, when you get like a double top formation, the whole idea is that liquidity is sitting here, right? Why is liquidity sitting in this situation? So let's think about it. So this is an area of resistance, right? So in terms of a standard retail strategy, people will be looking to sell from this and have their stop loss just above here, and and so on, the TPs, wherever. Okay, so people will be looking to sell off the support level. Also, there are people who will be looking for these sellers to be taken out, and they'll be looking to trade a breakout. So they'll be looking to trade, for example, here with a long position and the stop loss, I don't know, somewhere here. But what tends to happen, not all the time, but what sometimes happens is that price would come, trigger these sellers and trigger these buyers, okay, and then price will come crashing down, okay. So these sellers here, they're probably thinking, oh, they've just been stop hunted and price has gone in the overall direction. So they're probably happy the fact that they got the buyers correct, and they did. And these breakout traders have just been smoked, okay. So they're out. These are out, and liquidity has been grabbed and price is just flown, okay. Why does this happen? So remember, the market, it needs to have a equilibrium between, you know, winners and losers, okay. For someone to win, someone needs to lose. For someone to lose, okay, I don't know why I said that bit. Ignore that bit. For someone to win, someone needs to lose, okay. That's the main thing to think about. So that's the reason why this happens. So in this situation, the only reason why it's grabbing liquidity is because it's not got enough fuel for institutions to carry on the move. Now, the common misconception is that, you know, institutions are against us as retail traders, and the fact is it's not really. We're insignificant in terms of the forex market. Essentially, this is institutions against institutions, and the fact that the amount of money they're moving, okay, because only institutions can call these impulsive moves, okay. Only institutions can do that, and they're leaving footprints behind, which we'll speak about in the next episode of this series. But what you're thinking about is they're grabbing liquidity basically from each other, okay. That's the way to see it. Also, retail traders get caught up in the middle of it, so don't get too confused with that situation. But essentially, the reason why they do this is because they get that pit stop, grab that liquidity, and then they carry on price as they always wanted to go. And then price obviously comes back to mitigate the order block, as mentioned in the last video, and then they can continue that move. So this liquidity grab is a footprint in itself. Why? Because it's basically showing you when it grabs enough liquidity, you get that violent or impulsive, however you want to call it. It's a violent or impulsive natural move that comes and it breaks structure and so on. So it's leaving behind an order block, it's leaving behind imbalance, which we'll talk about in another episode, and it's grabbed liquidity. So it makes sense that institutions were active here, because only institutions would sacrifice a position for this to happen. For example, say this is a continuation move and price is already coming from, I don't know, somewhere up here. Okay, this is just a continuation. It will make sense why it's grabbed liquidity and carried on. Okay, it makes sense. Now, there's another way that you can also see liquidity. Is basically the opposite way, is where you get double bottoms like this, for example. So in this situation, you have an area of support, and essentially you have buyers who will be looking to buy off the third touch of the support level, TP somewhere up there, stop loss just below, and you would have breakout traders who are looking to sell from this situation from here, stop loss there, okay. And then what happens to them is that price will come, trigger these buyers, trigger these sellers, grab that liquidity, and then go flying, and then they'll come back, mitigate their loss, and then continue, okay. So by us being a little bit patient, we'll be at this point here, okay. Whereas these people have just been grabbed. These people have been stop hunted. They've been taken out of the market. Enough people have lost, okay, in this situation, and then they can continue the move. But this liquidity grab is a footprint in itself. However, there's other ways to see liquidity, and this is something that's sort of overlooked. What you need to realize is, let's look at this bearish move, for example. There is liquidity, okay, sitting everywhere. Okay, what I mean by that, liquidity is liquidity is sitting above this high. I don't know if you had that phone call actually. If you did, apologies. I don't know if it'll be in the recording or not. But liquidity is sitting above every single high, and is also sitting above every single low. Okay, let's focus on this situation. Let's focus on the bearish situation. So in this situation here, what I mean is in terms of breakout traders, there'll be breakout traders who are looking to buy from, who are going to be looking to buy from a breakout of every single high that's being created, right? And then what happens sometimes is you get this random move that comes and triggers these guys in. Okay, it breaks structure, and this is when people get confused. When it breaks structure, that one break structure does not mean it's a change of trend. This is simply all it's doing. It's grabbing liquidity and then continuing. And it makes sense. Why? Because there's not, say you've got this really smooth move, okay, there's sort of an equilibrium in this sense. Okay, let me get rid of all this because I don't like the writing keeps flashing up. In this situation, it's a very smooth ride to the downside. Okay, so in this, we're just assuming. Okay, we're assuming that there's not enough liquidity, which is the reason why this happens. So when this happens, when this first break of structure actually occurs, this is just an alert. It's not anything to be worried about, and it's not an indication that price is going to come back and change a trend. Why? Because it can simply be a liquidity grab and price can continue. Okay, so just bear that in mind. Now, sorry, didn't mean to do that. Same situation if we're looking for a bullish move. Okay, liquidity is sitting below every single low in terms of breakout traders. Also, not even breakout traders. For example, in this situation, let me get rid of this, for example. In this situation, we have sort of like a trend line situation where from here to here, and we have the third touch, and we probably have a Fibonacci retracement, the golden pocket, and so on. And these buyers have been taken out, and so have these sellers. These breakout trades have also been taken out. Okay, to give you a visual representation, you probably have buyers here. Okay, using the standard retail strategy. I'm not saying it's a bad strategy, by the way, because it does work for some people. Fair enough. But I'm just trying to make sense of how the market logically moves, right? And in this situation, these guys are also being taken out. Okay, this gives you a visual representation of liquidity being grabbed. And what it's also showing us, okay, but the way that we see the market is the fact that this whole bearish move before that impulse, that is our footprint being left behind, because this bearish move is fake. Okay, I would say fake. In my words, I would say it's fake, because this move is engineered to grab liquidity, and it's leaving behind a footprint which we will refine to a certain candle, which is the order block, or sponsored candles, or whatever you want to call it. And that's essentially where we will be looking to continue. What the heck? There we go. Where we will be looking to continue the move up from. Why? Because it makes sense. It's grab liquidity, and that's basically the footprint that's been left behind. Probably get as an order block with inefficiency and so on, because this move will most likely be a violent move that will go on to break structure, and then we're going to trade off the footprint that's being left behind. Okay, so that's essentially so we already identified how to find your order blocks. However, this is the way that to understand your order blocks, because your order blocks essentially is where institutions are grabbing that liquidity from. Without these liquidity grabs, the market wouldn't be really functioning, okay, in that sense. So in this situation, let's just look at this Euro pound. So let's look at this, for example. Now, where I mentioned, another thing I need to mention, when you get price that sort of consolidates like this, okay, what does this mean? The buyers and sellers are in equilibrium, okay, they're happy with each other. There's a nice interaction between the buyers and sellers, okay. In this situation, what you need to think about is there's going to be a liquidity grab or an impulsive move, either to the upside or downside. This is when the market is deciding whether it wants to look for higher prices or lower prices, okay? And the indication that it's happening is either when it grabs liquidity and then flies, or sometimes doesn't even do that. Sometimes it's got enough liquidity and can go. But when it does grab liquidity, it's a good indication that the institutions are active. Because bear in mind, as retail traders, we cannot create this move. Okay, only institutions can. Okay, same thing going the other way. You can grab liquidity and then price can continue to the upside. So this is basically what's happening in terms of that when you get that consolidation period in the market. So that's another way where you get liquidity grabbed. For example, in this situation here, right, we have this consolidation market, it's grab liquidity and then prices continue to the upside. Okay, so it's looking for that higher price. Another way is we've got this area. This is a bit weird, a bit different one, because if in this situation we have a consolidation period, then we have this wick, okay, which grabs liquidity from all these highs and price flies down, okay, because it's grabbed that liquidity and it's looking for lower prices, also going on to break structure. Price sort of reacts to this order block, but however it's not strong enough to actually do anything. In this situation here, for example, it's grab liquidity from this previous high, because you're probably thinking in this situation, right, we've got this bearish move, okay, so we've got this bearish move here. This is a very odd move, to be fair, but it's a very impulsive move, and you're probably thinking, okay, this is a change in trend. And yes, in this situation, because you've got this first break of structure, however the next move, it didn't break, it just grabbed liquidity and prices just continued to the downside. This one failed to break structure and it continued to the downside. So it's not a change in trend in this example. So the way to see it is look out for areas of liquidity. It's not just equal highs and equal lows. It's basically every single high and every single low in this situation. So what the main thing to take away from this is that when you get a break of structure, for example, is there an example here? Okay, here, for example, we have this high. This is just a rough example, but we have this high, we have this low. This candle has just wicked above this high, right? And then it's just flowing through. This is a good indication that institutions are active in this scenario that's playing out here, because it's grabbed liquidity and gone. Now, if you use wick breaks as your structure breaks, then this will probably be a break of structure for you, and some people will be looking to buy. However, we are patient to wait to see what happens, because just one break of structure is not enough to tell us that that is a changing trend. It can simply be a liquidity grab, and when a liquidity grab happens, it leaves behind an order block, which price didn't mitigate just yet. But bear in mind, in this situation, price reacted to here, which I don't really use this. I believe they're called breaker blocks or whatever they're called. I don't really use them. I don't like them. I prefer using the actual order block myself. That's just my preference. But in this situation, you need to remember that an order block can either have one or two things. It can either be respected or it can be violated, right? It doesn't always have to be respected, okay? Just bear that in mind. But that's basically what you need to think about is if you get that initial break of structure, don't be too concerned. Say for example you're in a bearish trend as you are here. If you get that break of structure, don't be too concerned, because it can simply be a liquidity grab. So wait and be patient and see what happens. Patience is the key in this situation. But I'll end the video here, and I hope that you've enjoyed it, and I hope that you've enjoyed the second episode to this. Again, I just want to say that if you want to join our course program, which is the course only program, it's a lot cheaper. It works out to about £69 a month, and you're not entitled to stay, but you get full access in that first month to our course. So if you simply just want to use our course and take it away, then so on, you can feel free to join using the LaunchPass website down below. Or if you want to join the mentorship and have actual support from myself and the other 3 mentors, obviously feel free to join the mentorship via our website. And we also have the bootcamp coming up in March, which is on March the 20th, I believe. Let me just quickly check. On the March 20th to 21st, we have the live bootcamp, should you wish to join that, where you get taught live. But for now, I hope you guys enjoyed this video. Make sure you like and subscribe to this video so you don't miss out on any of the content that we share. I've also started a playlist for this series as well, so you can find it quite easily as well. For now, take care and trade safe.